One of the drivers, well, particularly for some of the large US funds, is there was a degree of panic, I think, towards the back end of last year about, look, you've been at European distress for 2 years or so and you haven't spent as much money as you could. And some of that was driven by, one could call it unrealistic pricing expectation, I don't know. But fundamentally, we've seen these underwriting criteria, as I mentioned in the introduction, getting a lot tighter. Because what the investment committees in the US have said, it's not on all funds, but I know it's happened on more than one occasions, is look at the shape of the recovery in the US, look at asset prices and how quickly they've gone back. If you don't spend your money now, you're not going to be able to do that in the next 2 to 3 years. And I think since then, and that's probably started Q3 of last year, from what we witnessed, big checks have been written. And I think that comes back to this reduced IRR, because whilst 15 may not be 20, is better than 10 in 6 or 12 months. So that was certainly some of the catalyst for some of the biggest check written. I think certainly what people are, I don't know whether they are learning, but applying is the pace at which the recovery can happen in a certain country. Sorry, and I don't define recovery as in GDP growth, I define recovery into how quickly prices can come back up. So, going back to the examples of the US investors, because I think there is a bit of a US-European divide in terms of how people approach their underwriting. People look at the UK and say, look, that didn't look good in 2009, and look at where we are today. People used Ireland and say, well, look, actually it looked terrible, but look at the prices in Dublin, how quickly they've come back. It doesn't take much for them to say, Spain. And he's absolutely right that some of the money that was raised, had a very neat map of Europe with little flags saying we'll spend X there, and that's where the money is going to get spent. So we know people saying, look, underwriting criteria, yes, this is all the kind of stuff I'm looking for. But fundamentally, I've been told I need to do a deal in Spain. And at the end of the day, that's the driver, because whether the deal is good, bad, or indifferent, clearly everyone will make sure it's as good as it can be. But when you have many people chasing for the same thing, it's supply and demand. And there is a little bit of that herd mentality going on.
Okay, good.
I think the guys in the way, they need to sort of think forward and think, well, when they come to exit, how deep will the market be at that time? And will they have a product that the investment market at that time will want? And you're talking, say, 3, 4, 5 years ahead. That's more difficult to predict in some ways, particularly like normalisation of interest rates, but also it's quite difficult to predict what the economy will be like. And obviously there's going to be some correlation between the real estate performance and the economy. So I think that's a sort of complication. But just take the example of Greece. We had a client go out to Greece on a so-called tour, and they came back saying, well, to do Greece, it would have to be a no-brainer, and it wasn't yet a no-brainer. So they haven't done anything in Greece. But equally, I saw that Hines have just bought a portfolio of resort hotels in Greece, no doubt at a significant discount to replacement cost through some dislocated deal, premised on the assumption that because there's more and more tourists coming into Greece, and I think some of the hedge funds like Paulson and Co, people like that, are now circling Greece as well.